Hello all. Today we will have a discussion on the topic working capital and financial analysis. This is the 13th video on working capital management. So far we have just discussed the topic from the perspective of the finance manager. In this topic we will consolidate our discussion and then we will try to make it meaningful for top level management, right? So that means in the board meeting, if the top level managers are going to discuss about the performance of the company, there they are going to touch upon all these aspects what we are going to discuss in this video. So there are 5 questions we are interested in. How should we do working capital requirement analysis? How should we measure the impact of working capital on operating cash flows of the company? How should we assess the impact of working capital on profitability and sustainable growth rate? How should we relate working capital with economic value added? And the last one is, how should we do comparative analysis on working capital? In order to take our discussion further, I have just considered one hypothetical illustration. The name of the company is Bala Harsh Shirish Limited, BHSL, and their income statement for the latest 3 financial years are given like this. Amount in INR crores. So I have made a table like this: particulars, year T minus 2, year T minus 1, year T, and then inference. Okay, we want to know whether a particular line item is increasing or decreasing. In order to in order to reflect that, we have just gone for the inference column, right? So we'll start with revenue. Started with 5,000 crores, gone up to 6,000 crores, gone up further to 8,000 crores. So that means it is indicating growing trend. Cost of goods sold for the company started with 4,000 crores, gone up to 4,800, gone up to 6,400. It is also indicating increasing trend. Gross profit for the company in the year T minus 2, it was 1,000 crores, gone up to 1,200 crores, gone up to 1,600 crores, again showing increasing trend, which is good for the company. SGA, selling general admin expenses, started with 227, gone up to 213, gone up further to 399. So it has come down and gone up, right? So that means initially it was coming down and then going up, fluctuating trend. If you look at depreciation amortization, it is remaining flat at 200 crores. So that means straight line method of depreciation, right? So the EBIT or operating profit for the company started with 573 crores, gone up to 787 crores, and further it has gone up to 1,001 crores. So that means it is showing increasing trend, which is very good for the company, right? Yeah. And the next one is interest expense. Started with 200 crores, gone down to 190 crores, gone down further to 180 crores. So that means it is indicating decreasing trend, which is good for the company. That means borrowing is coming down, right? Yeah, which is good for the company. The EBT or PBT numbers were like this. In the year T minus 2, it was 373. In the year T minus 1, it was 597. In the year T, it was 821 crores. So that means it is showing increasing trend. Tax expenses started with 123 crores, gone up to 197 crores, gone up further to 271 crores, and it is 33% basically. PAT for the company started at 250 crores, gone up to 400 crores, gone up further to 550 crores. So indicating growing trend. So that means all the profits, gross profit, operating profit and PAT are indicating growing trends, right? That is good for the company. Dividend for the company, initially it was 50 crores, then gone up to 100, gone up further to 150 crores. And the amount of money transferred from income statement to balance sheet in the form of retained earnings. In the very first year it was 200 crores, second year it was 300 crores, last year it was 400 crores, which is again indicating a growing trend, which is very good for the company. Shareholders will be happy about this, right? Yeah. So I will take you to the balance sheet of the company. So again 3 years, T minus 2, T minus 1 and T, and then last column we have labeled as inference. So starting with assets, starting with current assets, there are only 3 components we have considered here. First line item is cash. Initially it was 500 crores, gone down to 400 crores, gone down further to 300 crores. That means cash balance is coming down. Why it is coming down needs to be investigated. Accounts receivable started with 1,000 crores, gone up to 1,300 crores, gone up further to 1,600 crores, which is a cause of concern because our money is blocked in, right, others business. Inventory started with 1500 crores, gone up to 1800 crores, gone up further to 2400 crores, again indicating a growth trend. Again our money is wasted in the form of inventory, cause of concern. So why is it happening? Things need to be investigated. So the total current assets of the company at year T-2 was 3000 crores, and T-1 it was 3500 crores. For the year T it was 4300 crores. It is going up. Net fixed asset started with 2000 crores, gone down to 1800 crores, gone down further to 1600 crores, indicating a drop in net fixed asset. That means it's primarily because of depreciation. That means the depreciation is 200 crores per year. Total assets of the company at year T-2 was 5000 crores. At year T-1 it was 5300 crores. At year T it was 5900 crores, indicating a growing trend. If you go to the liabilities and owner's equity, starting with current liabilities, the very first line item is accounts payable. The company had initially 800 crores as AP, gone up by 100 crores to 900 crores, and then it was remaining flat at 900 crores. So that means initially it was going up and then it was remaining flat. The next line item under current liability is accrued expenses. Initially it was 300 crores and remaining at 300 crores in the next year, and then gone up by 100 crores to 400 crores. So that means initially it was flat and then it was going up, right? So that was your accrued expenses. Short-term bank loans, initially it was 900 crores, going up to 1000 crores, going up further to 1200 crores. So that means right, it is indicating a growing trend. If the economy is not doing well, if the bankers are not happy about their non-performing assets or poor asset quality scenarios, then there will be a problem in terms of, right, this number going up, right? So the total current liability, initially it was 2000 crores, gone up to 2200 crores, gone up further to 2500 crores, right? If you look at long-term debt, initially it was 1000 crores, gone down to 800 crores, gone down further to 700 crores. It is good for the company. That means the company's ability to borrow money, right, in long term is going up, right? And the last item is OE, owner's equity. Initially it was how much? Initially it was 2000 crores, gone up to 2300, gone up further to 2700 crores. So that means it is indicating a growing trend, which is good for the company, right? So the total of liabilities and owner's equity, 5000 crores, then year T-1 it was 5300, and for year T it is 5900 crores, again going up, right? So this is what the income statement and balance sheet of the company, right? So now what we are going to do is we are going to become top level managers, and then we are going to look at all these numbers, and then we are going to make some sense out of this in terms of knowing how it is affecting our overall financial performance, right? Yeah. So the very first thing we are going to do is we are going to start with working capital requirement analysis. So I have made a kind of table like this, wherein the very first column is labeled as particulars, second one is T-2, third one is T-1, fourth one is T, year T it is, and the last one is inference, right? So we'll start with computing working capital requirement. What is working capital requirement? It is the money required for meeting your day-to-day requirement of, right, funds, right? So basically this is your accounts receivable plus inventory minus accounts payable and accrued expenses, right? Yeah. Let's go to the balance sheet once. Let's look at the current assets. We are having three current assets, namely cash, accounts receivable and inventories. Since we are talking about non-cash working capital, we will not consider cash. This item will be dropped, right? So we will have only two items left out in current assets, namely accounts receivable and inventories, right? Yeah. And then we will go for current liabilities. If you look at current liabilities, there are three items: accounts payable, accrued expenses and short-term bank loans. Since we are talking about non-interest bearing current liabilities, because we are talking about non-cash working capital, we will not be considering short-term bank loan, which will be taken for computation of cost of capital. Okay, cost of debt we will be computing, right, Shirish? So there we will be taking this number, right? Yeah, Bala, I hope you are getting this, right? You asked me a question on this, right? So that means we are going to consider only two current assets, namely accounts receivable and inventories. which are known as non-cash current assets. We are going to consider only two current liabilities, namely accrued expenses and accrued expenses and accounts payable, not short-term bank loans, right? Because we are talking about non-interest bearing current liabilities. So now let's come to working capital requirement computation. For the year T minus 2, how much it is? Could you calculate, guys? For the year T minus 2, it was 1400. How did I arrive at this? Vivitsa, could you please help us in doing this number? Let's go for year T minus 2. Accounts receivable, cash we are not considering. Accounts receivable 1000 plus inventory is 1500. Total is 1000 plus 1500, 2500. Minus current liability AP 800 minus accrued expenses 300. So that means out of 2500 we are going to subtract 1100. So that means the answer is going to be 1400. The answer is going to be 1400. Am I right? Navneet? Yeah. So working capital requirement for the year T minus 2 is 1400. Right. So now Padmanabh is going to help us in calculating the number for T minus 1. Kushagara? Yeah. Why don't you help us? Right. Along with Abhi. Right. Nikhil, you can also join them. Nikhil. Nikhil join. Yeah. Right. So T minus 1, it is going to be accounts receivable 1300 plus inventory is 1800. So that means total is 3100 minus accrued expenses 300 minus short term minus accounts payable 900, accrued expenses 300. Short term bank loan we should not consider, right? So that means how much it is, right? So it is going to be, right, 1900. It is going to be 1900. For year T it is 2700, right? Like that we can compute, na? So that means what is happening here is it is increasing year after year, which is not good for the company, right? So the next thing is we have to convert this number into a normalized number, because working capital requirement is in absolute term, right? We can't make any conclusion or inference based on absolute numbers. So that means in finance we need some normalization, right? So what are we going to do is we are going to make a ratio, namely working capital requirement, right, by revenue, right, percentage. So that means for the year T minus 2 it is 1400 divided by revenue of 5000 multiplied by 100 gives us the ratio of 28%. For the next year it is 1900 divided by 6000 multiplied by 100 gives us the number of 32%. For year T it is 34%, right? For year T it is 34%. How do we get that? We get working capital requirement of 2700 divided by revenue of 8000 multiplied by 100, right? So if you do that, then what is the inference here, guys? Actually it is increasing by 2% every year, right? So that means company is spending or investing more in terms of working capital as a percentage of revenue. That's what you are getting here, right? So the next one is we have to compute CCC, right? It is another normalized measure. Only thing is it is going to help us in terms of reflecting the number in terms of days, right? So we'll start with days receivable, wherein the formula is accounts receivable by revenue multiplied by 365. So let us start doing this for the year T minus 2, right? Yeah, Kashish, why don't you help us in doing this, right? So I'm going to start with accounts receivable. Let's first look at the balance sheet. Yeah. So let's look at the accounts receivable numbers. 1000 for year T minus 2. For year T minus 1 it is 1300. For year T it is 1600, right? So if you come to the computation now, you can see in the numerator 1000, 1300 and 1600 divided by revenue for all the 3 years, 5000, 6000 and 8000. So if you multiply by 365, it gives us a number of 73 days for the year T minus 2, 79 days for the year T minus 1 and 73 days again for the year T. So that means initially it is going up and then it is coming down, right? So what is days receivable is otherwise known as? Days receivable is otherwise known as average collection period, which is otherwise known as DSO. That means daily sales outstanding. Okay, marketing term it is, right? So that means how many days we are taking to collect the receivable from the customer who has purchased the product on credit sales, right? The lower the days receivable, the better is our collection efficiency. So that means 73 days, 79 days and 73 days. So it gives you some inference, right? So that means initially we were going out of zone and then you are coming back, but still 73 days seems to be slightly higher, so that means you have to do something about it, right? So let us go for the next number. The next one is DI, days inventory, right? So it is computed by the formula inventory by CGS multiplied by 365. Okay, in the first one the denominator was revenue, in this one the denominator is CGS, cost of goods sold, right? So that means inventory by CGS multiplied by 365 is going to give you what is your days inventory, right? So let's look at the number inventory. So let's go to the balance sheet. Please look at the number for inventory. 1500, 1800 and 2400, right? Yeah, 1500 year T minus 2, 1800 for year T minus 1 and 2400 for year T, right? Divided by what is your CGS, 4000, 4800 and 6400. So multiply by 365 gives you the number of days we are storing inventory, right, in our warehouse or godown, right? So initially it was 137 days, huge. Again 137 days, remaining same at 137 days, right? So that means how many months? How many months, Sharansh? 4.5 months, right? Our money is getting blocked in inventory, right? So you are an operations guys, ops guys, right? So that means, right, your working capital, right, management in terms of inventory management is not at all good. So you guys need to do something about that, right? Yeah. So let's go to the next component, that is days payable, DP. The formula is accounts payable by cost of goods sold multiplied by 365. Cost of goods sold we have already considered in the previous formula. So that means all the denominator we can straight away write 4000, 4800 and 6400. And we have to look at what is our accounts payable, right? Please look at the balance sheet. Look at the accounts payable. 800, 900, 900. So come back. 800, 900, 900, right? So if you compute the days payable, it is coming to be 73 days and then coming down to 68 days and then coming down further to 51 days. So that means it's keep on going down. That means, right, your suppliers are tightening the belt, right? So on the one hand, right, you find your accounts receivable, days receivable is right at 73 days. On the other hand, you see your days payable for the latest year 51 days. So that means there is a gap. Okay. So that means suppliers are able to tighten the belt, whereas we are not able to do to the same extent, right? Yeah, with our customers, right? That's what I'm talking about. Yeah. Go ahead, go for the last one. That is days accrued expenses. Formula is accrued expenses divided by CGS multiplied by 365. CGS we already know. So denominator is 4000, 4800 and 6400. Accrued expenses, please go to the balance sheet. Look at the numbers. So accrued expenses, here it is 300, 300 and 400, right? So if you just put that number 300, 300, 400, right, multiply by 365. So year T minus 2 it was 27 days. Year T minus 1 it was 23 days. And year T again it is 23 days. So that means we are taking 23 days to clear the accrued expenses, right? So that means to that extent we can make use of the money, right? So that means accounts payable we are taking 51 days to clear. To that extent we can make use of that money, right? Similarly, the accrued expenses we are taking 23 days. So that means put together it is around 74 days, right? 51 plus 23, right? Yeah. So let's consolidate the numbers. Cash conversion cycle. For the year T minus 2, it is 110 days. How do you get that? 73 days receivable plus days inventory 137 minus days payable 73 minus days accrued expenses 27 gives us 110 days. For the next year, it is 125 days. For the last year, it is 160 days, right? Shilpa, could you help us in computing for year T, right? That means 73 days receivable. 73 days receivable plus 137 days inventory minus accounts payable, days payable 51 days minus accrued expenses 23 days gives us 160 days, right? So that means we are taking 160 days to collect the money back from the customers. So that means beyond 5 months, right? So initially it was 110, going up to 125, going up further to 160. So that means pretty huge number. So it keeps on increasing. That means we are not at all efficient in managing our working capital components, right? So this is the real life numbers. If you happen to be a consultant to this company, so what you guys are going to tell them, right? Based on the numbers, right? Yeah, please think about it. Yeah, Rohit. Right. Rohan, why don't you tell? Right. Correct. Very good. Very good. Right. So that means what you are telling here is this. The days receivable 73 days can be cut down. Days inventory 137 days should definitely come down. So that means we have to improve our collection efficiency to reduce days receivable. We have to improve our inventory management practices to decrease this 137 days. And we should go for better negotiation with, right, the suppliers, because profitability wise the company seems to be doing an excellent work. We have seen the income statement, right? All the profit margins are going up, right? Gross profit, operating profit, PBT, PAT, all four of them are going up year after year in the last 3 years, right? So that means profit wise company is doing pretty good. So that means why should we not negotiate with the suppliers to give us, right, a better term, right? So this is another suggestion you can give. And the last one is days accrued expenses. It is remaining more or less at 20 plus days. So you can't do much about it, right? Because you can't, right, prolong the payment of salaries to your staff. On the one hand, you are claiming you are very profitable. On the other hand, if you don't pay salaries to your staff, right, they will run away from you, right? Yeah. So that means we can't do much about days accrued expenses. Let it be as it is. Whereas other three components should be, right, managed better. Yeah. So the second leg of this working capital requirement analysis is this. Yeah. The second leg of the working capital requirement analysis is this, right? So we had seen, right, where we are investing money, how much we are investing in receivables, how much we are investing in, right, our inventory, right, how much we are getting from accrued expenses and accounts payable, right? Now we want to know where from we are getting this working capital gap. Okay, we have working capital requirement. That means that 1400, right, 1900, 2700, we need this much money because it is basically the difference between current asset and current liability, right? So that means we want to know where from this gap is going to be met, right? So how much is going to come from your long term? So we have to know out of every 100 rupee we are investing in working capital, how much is coming from long term sources of funding, how much is coming from short term sources of funding, right? So this is actually looking from the other side of the balance sheet, right? So that means long term funding is nothing but long term debt plus owner's equity minus net fixed asset. So that means if you look at the right hand side of the balance sheet, long term sources of funds are these two, long term debt and owner's equity. And if you look at the asset side of the balance sheet, long term investment is your net fixed asset, right? So we are looking at the difference, right? So that is the amount which is going for funding investment in working capital requirement. So that means for the year T minus 2, it is going to be 1000 plus 2000 minus 2000. 1000 is your long term debt, 2000 is your owner's equity, minus net fixed asset is 2000, is going to give us how much, right? Why don't you tell me, right? 1000, right? So 1000 by 1400 multiplied by 100, it is going to give us 71%, right? If you go for year T minus 1, it is going to be 800 plus 2300 minus 1800 divided by 1900. I repeat, 800 is your long term debt, 2300 is your owner's equity, add these two. From that subtract the funding of net fixed asset, 1800. So what is left out is the amount that is going for funding investment in working capital requirement, right? So how much does it come to? 68%. For the year T, it is coming to 67%, right? So that means is it going up or coming down, guys? Actually, it is coming down. From 71, it has come down to 68. From 68, it has come down to 67, right? So that means the remaining number is nothing but the number coming from your short-term sources of funding, na? So which is computed as short-term debt minus cash divided by working capital requirement multiplied by 100. So that means short-term debt, right, that is your bank loan. For the year T minus 2, it was 900 minus cash, it was 500 900 minus 500 divided by 1400 multiplied by 100 gives us a percentage of 29%, right? So that means for the year T minus 2, out of every 100 rupee invested in working capital requirement, 71 rupee is coming from long-term sources of funding, okay? Whereas only 29 is coming from short-term sources of funding. Actually, if you go for duration matching, right, wherein we are going to match the timing, right, of the investment with the funding alternative, we should have maximum number coming from your, right, short-term sources, right? It should be the other way. But for this company, if you look at, right, for all 3 years, the long-term sources of funding is at a very higher rate, right, above 67%, right? Whereas here it is only around 30%, right? So that means out of every 1 rupee, right, 2/3 is coming from long-term sources of funding, whereas only 1/3 is coming from short-term sources of funding. So that means the company has to think about this, right? So why the company is doing this? Whether the company is gaining out of, right, getting the, right, long-term sources of fund at lower cost of, right, funding, or the company is not able to mobilize short-term bank loan from the banks, that's why it's going for long-term funding. The company has to really think about it. Ideally speaking, this is not the correct practice, but somehow the company is doing this, so that means there is a need for further analysis on this aspect, right? Yeah. So I move further. So I take you to the second question here, wherein we are trying to find out what is the impact of working capital on operating cash flows, right? Operating cash flow is a key number in financial analysis, particularly when you go for, right, giving an application for getting a loan from a bank. The bank is definitely going to look at your operating cash flow, right? So that means it should be positive, it should be increasing year after year, right? So that means now we want to know, because we are talking about working capital management, is there any relationship between working capital and operating cash flow? That is what we are interested in investigating now, right? So let's look at the company for 3 years. So let's start with your EBIT, right? We'll start with EBIT, year T minus 1 and T. We are not considering year T minus 2 because we need to have delta working capital, so we can't find out that, right, because we don't have year T minus 3, right? So that means out of 3 years we are taking only year T minus 1 and year T, right? So we'll start with the EBIT now. So let's go to the income statement. Let's look at the number of EBIT. If you look at EBIT for T minus 1 is 787 and EBIT for T is 1001 crores, right? Yeah, right, 787 and 1001. With EBIT we are going to add depreciation and amortization because we are talking about cash flow, and depreciation amortization is an example for non-cash expense. So add the amount of depreciation for the period, that is plus 200, here also plus 200. And then go for adjustment for delta working capital. It can be a plus or it can be a minus. If working capital is going to come down, you will be adding that, it's a plus because money is getting released, cash is increasing. If working capital is going to go up, you are going to give a minus because money is going out, right? Yeah. So let's look at the number now. So for the year T minus 1, the working capital amount is 1900 crores. For the previous year, the working capital amount was 1400 crores. So that means it's increasing by 500 crores. So it's an increase. That means money is going out. So that means it's a minus year. Okay, right? Similarly, for the year T compared to year T minus 1, the delta is 800. How do you get that? The working capital for the year T, it is 2700 crores minus the working capital for the previous year T minus 1, that is 1900, gives us delta working capital of 800. So that means money is going out, so it's a minus. Okay, since the minus is going up, because of that money is going to go out, cash is going to come down. So I have given an inference of, right, downward, right, arrow, right? That means decrease in the cash flow. The last one is payment of taxes. So for year T minus 1, absolute number is 197 crores. For the year T, it is 271 crores. If you wish, I can take you to the income statement, right? Yeah. Please go back to the income statement. Look at the number of taxes. Year T minus 1, it is 197. Year T, it is 271, right? So simply give a minus here, minus 197, minus 271. So if you do that, what you are getting is cash flow from operating activities. For year T minus 1 it is 290, for year T it is 130, right? So is it going up or coming down? Actually it is coming down by 160, right? Operating cash flow is coming down by 160, not a good sign for the company. Why is it coming down? Because working capital is going up by 300, right? This is one of the key reasons, right? So that means, suppose assume that there is no change in working capital, right? That means, right, delta in year T, assume it is going to be 0, right? So what is going to happen to the company, right? The cash flow is going to go up, right, to the amount of, right, your working capital requirement, right? So that means what? Lower the working capital, right, higher is the cash flow, right? Cash is very important, particularly a time like COVID right now, economic crisis, wherein cash is really king, right? So that means we need to generate more and more cash. So we should not just concentrate only on profit, right? We should not just concentrate on managing assets and liabilities. We should also focus on cash, right? We are growing, that is perfectly fine, but we also need cash. So that means when you are increasing your working capital requirement because you are growing, what is getting affected is your cash flow. You have to make sure that your cash flow is managed better, right? Yeah. I take you to the third question. It's the most important question because we are trying to find out what is the impact of, right, your working capital on profitability and sustainability of the firm, right? We want to know what is the impact of this on the profitability and sustainability of the firm, right? Yeah. So that means what I have done is I have created, right, as usual, right, 5 columns: particulars, T minus 2, T minus 1, T and inference. We will start with profitability. We will start with the very first profit margin, that is pre-tax operating margin. So that means before you consider tax, what is the operating margin for the company? That's what we are interested in. Formula is EBIT by revenue, earnings before interest and tax. Before paying tax, what is your operating profit? That is what your EBIT. So EBIT by revenue multiplied by 100 is going to give you, right, how much is your pre-tax operating margin, right? For the year T minus 2, it is going to be 573 by 5000 multiplied by 100, which is going to give us a margin of 11.46%. For the year T minus 1, it is going to be 13.12%, 787 divided by 6000 multiplied by 100. For the year T, it is going to be 1001 divided by 8000 multiplied by 100. Okay. So if you want to go to the income statement, I can take you. There is no problem. If you look at your EBIT here, 573, 787, 1001. Sales revenue 5000, 6000 and 8000, right? Yeah. So exactly the same numbers are written. Yeah, you can have a look at, right? Yeah. So guys, the pre-tax operating margin is actually, right, going up initially and then coming down, right? From 11.46% it has gone to 13.12. That is good actually. And then it has come down to 12.51, right? Yeah. I take you to now the next leg, that is invested capital turnover. So formula is sales by invested capital multiplied by 100. Invested capital formula is net fixed asset plus working capital requirement. There are 2 ways in which you can find out invested capital. If you go from the liability side, you will be adding your long-term debt and owner's equity. If you go from the asset side, you will subtract your current liability from total assets, right? The third way is this: you can simply add your net fixed asset and your working capital requirement, that is nothing but current assets and current liability, right? So invested capital is computed this way. So that means every 1 rupee we are going to have in terms of working capital, that is the difference between current asset and current liability, is going to add our invested capital, right? So that means what is the formula for invested capital turn? Sales divided by invested capital. What does it measure? For every 1 rupee invested in invested capital, how many rupees we are getting in our sales revenue? Higher the number, better is the performance, right? Yeah. So let's look at for this company. For the year T minus 2, it is 5000 by 3000, okay, which is giving us invested capital turn of 1.67. For the next year, it is 1.94, right? Invested capital turnover, right? How do we get that? Revenue 6,000 divided by invested capital 3,100. How do we get 3,100? Reshmi, right? Could you please tell? Right? Gayatri? Yeah? Anand? Right. So it is 1,800, that is your net fixed asset, plus, right, your difference between current assets and current liability, 3,500 minus 2,200, right? So that is your net working capital, right, or your working capital requirement. So that gives us 3,100, na? So that means we are getting working capital, invested capital turnover of 1.94. For the next year we are getting 2.35. So what you observe here is a wonderful thing. Actually the number is going up year after year. It keeps going up. That means the company is using its invested capital properly in terms of generating more revenue, right? So that means that is a good part of the company, even though its pre-tax operating margin is fluctuating, going up and coming down, right? So if you multiply your pre-tax operating margin with your invested capital turn, what you are going to have is you are going to have pre-tax ROC. That means for the year T-2, it is going to be 11.46 into 1.67, which is going to give us pre-tax ROC of 19.13. For the next year, it is going to be 25.45. That is 13.12 multiplied by 1.94. For the last year, it is 12.51 into 2.35, which is giving us pre-tax ROC of 29.40. Actually, it is going up, right? You can see here, na? From 19, right, Kushagara, it has gone up to 25. From 25, Abhi, it has gone up to 29, right? Yeah. So, Rucha, could you help us in making the inference here, right? So, the company can increase its pre-tax ROC either by increasing its invested capital turn or by increasing its pre-tax operating margin. Okay. In pre-tax operating margin, we are not talking about working capital directly. Whereas, in invested capital turnover, we are talking about working capital directly, because invested capital consists of two elements, namely net fixed asset and working capital. So that means higher the working capital, higher is the invested capital. That means in the formula, higher is the denominator. That means the output is going to be lower, right? So if the working capital is less, then your invested capital is going to be less. That means your denominator is less. That means your ratio is going to be more, isn't it? So from this, what we understand here is that the company's pre-tax ROC is going up, even though its profitability is at stake. But we have already gone through the working capital trend, wherein the working capital requirement is increasing year after year, right? So that means even after the working capital is increasing, the company is generating higher invested capital turnover. Suppose if we are not seeing the trend of increase in working capital, needless to say, the company would have generated, right, wonderful invested capital turn, right? So even after, I am repeating, even after increasing working capital investment, the company is showing healthy trend in terms of its invested capital turn, right? Yeah, move ahead. So let's multiply pre-tax ROC with financial leverage in order to get, right, and into tax retention rate in order to get ROE. Return on equity is a function of pre-tax ROC multiplied by financial leverage multiplier multiplied by tax retention rate. Financial leverage multiplier formula I have given here. That is nothing but pre-tax ROE divided by pre-tax ROC. We have already computed pre-tax ROC for all the 3 years. We have to compute now pre-tax ROE. The formula is PBT by OE multiplied by 100. So that means for the first year it is 373 by 2000 multiplied by 100. That is giving us 18.65%. For the next year it is giving us 25.96%. For the latest year it is giving us 30.41%, right? So if you are going to use this number, right, in terms of the formula, that means pre-tax ROE by pre-tax ROC. That means for the year T-2 it is going to be 18.65 divided by pre-tax ROC 19.13 gives us the financial leverage multiplier of 0.97. Whereas next year it is 1.02. Next year it is 1.03. That means financial leverage is increasing. What does it mean? The company is borrowing more, right? Yeah, correct. Right. Yeah, Panindra is asking a very good question, right? So what is the question? Kashish, Dipshika, right? Sonak, what is the question? The question is, we have already seen the long-term debt is coming down in terms of the balance sheet numbers, right? Yeah. But how do you say the financial leverage is increasing, right? That is your question, na? Yeah. So when I say leverage here, we are summing up both your long-term and short-term, right? So later on, you just check the numbers. You will find the short-term debt and long-term debt numbers are going up year after year, right? Yeah. So that means the total borrowing is going up year after year. That's why your financial leverage is increasing, right? So that means more the financial leverage, more is the return on equity, because financial leverage or borrowing is going to give you tax deduction for your interest payment. That amount is going for equity shareholders. So that means one of the ways to increase your ROE is to borrow more, right? So that is what being incorporated here. So the last one is tax retention rate, that is 1 minus T. So that means tax rate is remaining same in this problem, 33%. So that means 1 minus 0.33 is 0.67 for all 3 years, right? So it's remaining flat, okay? So that means you multiply pre-tax ROC with your financial leverage multiplier and your tax retention rate. That will give us the ROE for the firm for the period. For example, for year T minus 2, it is 19.13 into financial leverage 0.97 into 1 minus T 0.67 is going to give us ROE of 12.43%. For the next year, it is 17.39. How do we get that? 25.45 into 1.02 into 0.67. Similarly, for the year T, it is 20.29. What you guys observe here is the number is increasing year after year. Okay, predominantly it is increasing because of two things. One is your increase in capital, right, invested capital turnover, as well as increase in your financial leverage multiplier. Yeah. So from there, I want to take you to sustainable growth rate. Before we talk about sustainable growth rate, let us understand what does it mean, right? Sustainable growth rate refers to the rate of growth at which a company can grow without borrowing money or without raising money from external parties. That means using your own money, how much is the maximum growth rate you can attain, right? That is what your sustainable growth rate, right? So the formula for that is very simple. It is nothing but ROE into retention rate. ROE, we have already computed. Retention rate formula is transfer to retained earnings divided by PAT. So that means for the year T minus 2, the amount transferred is 200 by PAT is 250, gives us the retention rate of 0.80. For the next year it is 0.75. For the next year it is 0.73. Actually it's coming down, right? That means the company is not retaining more compared to the previous years, right? That means the company is paying more dividend, right? Or the owners are taking more drawings if it is if it is not a company format, right? Yeah. So if you are going to multiply your retention rate with ROE, we are getting sustainable growth rate. For the year T minus 2, it is 9.94%. For the next year, it is 13.04%. For the latest year, it is 14.81%. It is keeping on increasing. That means if you look at the entire page once again, starting from the top to bottom, our objective here is to find out how investment in working capital or working capital efficiency is affecting the profitability and sustainable growth rate of companies. For that, what we have done is we started with pre-tax operating margin. We multiplied that with invested capital turnover. In pre-tax operating margin, we are not talking about direct involvement of working capital. Whereas in invested capital turnover, we are talking about direct association of working capital. And then we have found out pre-tax ROC. We multiplied that with financial leverage multiplier and tax retention rate in order to find out ROE. And then we multiplied ROE with our retention rate in order to find out what is our sustainable growth rate. So in a nutshell, what we have done in this question is we are interested in knowing how working capital is affecting the profitability and sustainable growth rate of companies, right? Wherein, so we multiplied pre-tax ROC with financial leverage multiplier and then tax retention rate in order to get ROE, and then we multiply by retention rate in order to get sustainable growth rate. Okay, so that means lower the working capital requirement, higher is the sustainable growth rate. That is what we are getting it, right? As well as higher is the profitability, right? So question number 4 is this: we want to know what is the impact of working capital on economic value added, EVA. So EVA formula is this: ROC percentage minus weighted average cost of capital percentage. Weighted average cost of capital is your otherwise cost of capital, right? Find out the difference in their percentage, multiplied by the absolute amount of invested capital. So that is going to give you your economic value added. So we have observed that in our earlier discussion requirement, our ROC is coming down conceptually because the formula is this, right? EBIT into 1 minus T divided by invested capital, wherein invested capital is a function of net fixed asset and working capital requirement, right? That means higher the working capital requirement, higher is the invested capital, lower is the ROC. Once ROC is lower, your economic value added will also become lower because the number is getting affected here, right? So that means what is the conclusion here? Conclusion is economic value added comes down for increase in working capital requirement or working capital inefficiency. So that means if you want to generate more EVA, then you should go for, right, generating more working capital efficiency, right? I take you to the last question of this model, wherein we want to know what is the impact of working capital on overall financial performance of firms, right? So wherein we are going for a benchmarking, right? So in this case, so far what we have done is whether we have done better compared to our earlier performance, because we have taken, right, a kind of a time series analysis. Here what we are interested in doing is we want to go for a cross-sectional analysis, wherein our firm, let us consider that to be VVRL, Vivitsa Veni Reshmi Limited, and they are compared with Ragini Limited as well as Nikita Limited. Okay, so last column is inference, right? I have not written anything, you guys can do that. So these are all the parameters on which you can compare. Working capital requirement, whichever company is having lower number, that is the best company. Working capital requirement by revenue percentage, whichever company is having the lowest number, that is the best company. CCC, whichever company is having the lowest number in terms of cash conversion cycle days, that is the best company. ROC, higher the better. ROE, higher the better. Sustainable growth rate, higher the better. Economic value added, higher the better, right? So it's a very simple page, but if you are going to put your numbers and then you are going to compare with your competitors, for example here I have written ROE of 20.29, other companies let us assume 12%, 14%, so needless to say your ROE is the best, right? Okay, so that means company is doing a good job, right? So that means when we are going to do financial statement analysis, when we are going to do investment analysis, when we are going to decide on whether to lend money to this company or not, right, we are going to do all this, right guys? Yeah, I think we have taken a longer journey. So that means these are all the questions we have answered in this video, right? Question number 1 is how should we do working capital requirement analysis? Question number 2 is how should we measure the impact of working capital on operating cash flow? Question number 3 is how should we assess the impact of working capital on profitability and sustainable growth rate? Question number 4 is what is the relationship between working capital and economic value added? And the last one is what is the relationship between working capital, right, and comparative analysis, right? See you guys in the next video. Please take care.